Hello, this is Jessica Dunn, and this is Economic Development Finance. We are covering Chapter 3, Financial Statements today. Um, you have the ability as a student at Murray State to use a database called Mergent. Financial statements are available on Mergent, and I did create a video explaining step by step how to use that. You can find it on Canvas. Additionally, you have access to the electronic data gathering and retrieval system by the SEC. You do not have to be a Murray State student to use this, so it is the somewhat preferred method because it is free. And financial information is available on Edgar as well. However, if you want financial ratios pre-calculated for you, Mergent is the better option. So we are going to examine financial statements. We're going to evaluate a firm's ability to repay debt. And we are going to use these financial statements to look and see how they have financed their previous activities. To do that, we're going to start with the balance sheet. Assets are economic resources owned by a business that will benefit future operations. So this would be things such as your cash, your accounts receivable, equipment, land, inventory, and any prepaid expenses that you have. Liabilities are obligations of the business. Equity, also called net worth, is the amount of claim owners have on the business. So the balance sheet is going to take together your equity and your liabilities, and that will equal your assets. So it's what you have invested plus what you've borrowed, and that's what your business has, or your assets. So it's what your firm has that is claimed by the owners, equity, or creditors, liability, and the possessions that belong to someone, the assets. Creditors have first claim on assets. Every financial transaction of a business must impact at least two accounts. When a change is made in an asset, either another asset must change or a financing account must change. And so we're going to talk about the difference between accrual and cash accounting. So college books acquired books in June, July, and August for $1,200. In September, college books sold and shipped these books for $2,000. Customers did not pay for the books until October. Monthly rent is $200 and salaries are $500. So from a cash standpoint, this is for September. In September, they didn't receive any revenue because the books were not sold until October. They also did not buy any books in September. All of the books were purchased in June, July, and August. They did, however, have to pay rent and salary, so they had a net income of negative $700 in September. From an accrual standpoint, the company purchased, or they sold $2,000 worth of books in September. That money wasn't actually received until October, but it was sold in September, so we would count it for the September financial statement. The cost of goods sold, the cost was actually recognized in June, July, and August. However, we now count for it in September because that's the time whenever the goods were sold. Rent and salary stay the same, and so that results in a net income of a positive $100. The accrual method shows a more complete and accurate picture of the store's financial results. So they did take all of these actions in September, but none of the money actually changed hands in September. The balance sheet. And this presents a summary of the firm's financial position at a given point in time. The statement balances what a firm owns with what it owes and what was provided by the owners. And it answers the question, where does my business stand today? So this is what a balance sheet looks like. We have assets on the left-hand side, and liabilities plus equity on the right-hand side. So on the asset side, we start with the most liquid assets and work down to the least liquid. So at the very top is cash. So to that we would add accounts receivable, and inventory. These make up current assets. Current assets are then added to fixed assets to give you total assets. So current assets are those assets that are expected to be converted to cash within 1 year, whereas fixed assets are long-term, such things as your equipment or your building. So this goes from more liquid so can be converted to cash quicker, to less liquid. On the liabilities and equity side, things are listed from short term to long term. So the most short-term liabilities that we have are accounts payable. These are things that we've bought on credit and intend to repay in the near future. To that we can add notes payable, and that gives us current liabilities. Current liabilities are short-term, and they expect to be paid within 1 year. If we add to that our long-term debt, that gives us total liabilities. And once we add in shareholders' equity, we have total liabilities plus equity. These sides must equal one another. So they must be equal to one another. Assets have to equal liabilities plus equity. So here's a picture of a balance sheet. So on the asset side, that's what we're looking at. Cash, obviously everyone knows what that is, but marketable securities are very liquid, short-term investments. These are usually things like T-bills or CDs. Accounts receivable is money owed to the firm by customers on credit sales. Inventories include raw materials, work in process, and finished goods. Fixed assets is the original cost of all fixed assets owned by the firm, so property, plant, and equipment. And depreciation is the total expense recorded for the depreciation of these fixed assets. On the liability and equity side, we start with accounts payable. That's money owed for credit purchases by the firm. Notes payable, these are outstanding short-term loans, usually from commercial banks. Accruals are amounts owed for services for which a bill has not yet been received. So it's money owed but not paid, so such things as salaries. Long-term debt is debt for which payment is not due in the year. Shareholders' equity is the owner's claim on the firm. Preferred stock is the historical proceeds from the sale of preferred stock. Common stock, the main thing of importance here is that common stock has a par value, and you use that to determine the number of shares outstanding. All common stock has a par value. These are usually set very low at $1 or less, because some states have rules that say that your stock cannot trade for less than its par value. So if your stock price were to fall and it was below your par value, that would be illegal. Paid in capital in excess of par in common stock is the proceeds received from the original sale of the common stock in excess of the par value. Retained earnings is the cumulative total return of all earnings that have been retained and reinvested in the firm since inception. So what about shareholders' equity? Shareholders' equity is divvied up into 3 different categories. First is par value. Par value, this is the stated value for stock that is legally required. Par value is calculated as the par value of the stock times the number of shares of stock issued, and that's how it will be listed on your balance sheet. It is interesting because the par value is not really related to anything. It has very little meaning. It's only used to calculate the number of shares of stock that you have outstanding. Additional paid-in capital. This is the amount of money that this stock is initially sold for minus the par value. And accumulated retained earnings. This is the increase in equity value due to reinvestment of current earnings. So the dividends payable to preferred stockholders are often cumulative. That means that if a company were to not pay their promised dividends to preferred stockholders this year, they would have to make that up next year, and they could not pay common stockholders anything until the preferred stock dividend had been paid. And so here's an example of that. Here this company has $325,000 in assets, $200,000 in liabilities, $30,000 par value for their cumulative stock, $20,000 par value for their common stock, and $46 million excess paid in capital. So if the dividends for prior years on the preferred stock have been paid, so they are up to date, and new dividends declared were $6 million, we can calculate the total dollar amount of dividends paid to preferred shareholders in the year end March 31st. To do that, we need to know how much they're supposed to receive in dividends and how many shares of stock there are. So this company, it's a 9% cumulative preferred stock, $100 par, and there are 300,000 shares issued. So dividends can be stated in percentage terms or dollar terms. Here this is stated in percentage terms. So they are owed a 9% of their $100 par dividend. So each share of stock is going to receive $9. So $9 multiplied by 300,000 shares outstanding would be the total dividend payable. So $2.7 million. So then the total amount of dividends paid to common stockholders would be anything left over. So $6 million total will be paid. $2.7 million is paid to preferred shareholders. So that means that $3.3 million will be paid to common shareholders. If we wanted to know the amount of dividends paid per share of common stock, we would take that 3.3 million and divide it by the number of shares of stock outstanding, 20 million. And they each get 16.5 cents. Okay, so let's look at a different scenario. Let's say that dividends were not paid in the previous year. So these are cumulative dividends that are owed to preferred shareholders. Cumulative. And so because they're cumulative, if you miss it, you have to make it up. So they missed their dividends the previous year. Let's say they're still going to pay $6 million total. So how much would belong to the preferred shareholders? We have our 9% times 100. That gives us a $9 dividend per year per share. So we have a $9 dividend times 300,000 shares outstanding times 2 because they missed last year's payment. And so this year, instead of 2.7 million, it will be 5.4 million. So the remaining amount of money, $6 million minus the 5.4 million, leaves us with 600,000 that will be paid to common shareholders. So how much will they receive per share of common stock? We divide that by the shares outstanding, 20 million. And they each get 3 cents. The income statement provides a financial summary of the company's operating results for a specific period. They are prepared quarterly for reporting purposes, so you can find these on the 10Q on EDGAR. But for management, they're usually computed monthly. So again, those are available on the 10Q statements on EDGAR. So the income statement, balance sheet, and cash flow statement are interrelated. The income statement is going to describe how assets and liabilities are used during the period. The balance sheet says, where does my business stand today? What do I owe? And what do I own? And the cash flow statement explains the inflows and outflows of cash. So one important way the financial statements are used together is in the calculating of free cash flow. We'll cover this more in depth in a minute, but a lot of free cash flow says that a company is able to pay their debts and their dividends. So first we're going to look at the income statement, which asks, how well did my business do during this period? So the income statement starts with revenue. This is any money paid to suppliers. This is any money that's brought in from the company. So in the sale of goods or services. From that, you deduct expenses. So any money that's paid to suppliers or employees. This includes things such as cost of goods sold or operating expenses. And from that, you subtract depreciation. So depreciation is not a real cash flow. At the end of the month, you're not going to have a check written to depreciation. But this gives you earnings before interest and taxes. From earnings before interest and taxes, you deduct any money that you pay on your debt, so the interest expense. And that leaves you with earnings before taxes. From earnings before taxes, you deduct any taxes. This is money that you owe to the government to give you net income. You deduct dividends paid to preferred shareholders. And that leaves you with the earnings that are available for the common shareholders. So at this point, there is one of two things that can happen with this earnings available to common shareholders. On one side, it could actually be paid to the shareholders. On the other side, it could be reinvested. So here's a good time to show you exactly what we mean by this whole double taxation. So here, corporations earn money and they pay taxes on this money at the corporate tax rate. They then take that money, and if they choose to pay it to shareholders, shareholders are then taxed at the personal income tax rate. So these people up here at the top, they have relatively little risk. So these are cash flows that have a little risk. So it's money that's going to be paid to your employees, to your debt holders, to the government. Down here at the bottom, for common shareholders, this is high risk, but unlimited return. So common shareholders are not promised anything, but they also face losing everything that they've invested within the company. At the same time, however, they have unlimited rewards. From the income statement, you can calculate earnings per share. Earnings per share represents the number of dollars earned during the period on behalf of each share of common stock, and is calculated as earnings available to common shareholders over the number of shares of common stock. Dividends per share, very similar. It's the dollar amount of cash distributed during the period to each share of common stock. And to calculate dividends per share, it's dividends paid to common shareholders divided by the number of shares of common stock. So here's an example of an income statement, which is posted on Canvas, so you can print this out via your PowerPoint slides. But earnings per share is equal to the earnings available to common shareholders, right here at the bottom of the page. It's back on black ink. So that's equal to 221,000. And we divide that by the number of shares of common stock outstanding. And we see in 2012 that that was 76,262 to give you earnings per share of $2.90. We could also calculate dividends per share. Dividends paid to common shareholders over the number of shares of common stock. The balance sheet and the income statement come together to give a full picture of a firm's financial performance. You need two balance sheets, one from the beginning of the period, one from the end of the period, and the income statement for the time in between. And you can look and see how their financial performance and their financial condition has changed over time. So you need to read them both together. For example, only the principal component of debt is recorded on the balance sheet. Interest payments are included in the income statement. To calculate total debt service for a year from the statements, you would need to sum the interest expense and the current portion of long-term debt from the balance sheet for the end of the prior year. We can look and see how both contribute to cash flow. The income statement generates cash flow by having higher revenue than expenses. This may be affected by the balance sheet. In general, an increase in asset accounts are a use of cash. Statement of cash flows. Is the summary of cash flows over a period of concern? So it reconciles these cash flows with changes in cash and marketable securities. And this statement ties the income statement and previous and current balance sheets. So this statement of cash flows is going to ask, where did our cash come from and how did we use it? So we have our sources of cash flow. And our uses of cash flow. These fall under three separate activities. Our first is profitable operations. So the main way that we receive cash flow is to have a profitable business. The opposite of that is unprofitable business. The second is the sale of long-term assets. The opposite, a use of cash flow, would be the purchase of long-term assets. Another way that a firm can receive money is an equity infusion. So the owner invests money. The opposite of that is a withdrawal by the owner. Another source of cash flow is long-term borrowing. And the opposite of that is the repayment of debt. So these four sources and uses of cash flow fall into three unique activities. So profitable and unprofitable operations are considered operating activities. The purchase and sale of long-term assets are considered investing activities. And finally, numbers 3 and 4, equity infusions and withdrawals, long-term borrowing and repayment, are considered financing activities. So operating activities, cash flows from those, are cash flows that arise from normal operations. Cash flows from investing activities. These are cash flows that arise from activities such as the acquisition or disposition of current and fixed assets. And cash flows from financing activities. These arise from raising or decreasing cash through the issuance or retraction of additional shares or through short-term or long-term debt for companies' operations. And here is a visual of a cash flow statement. So each of these actions are broken down according to their activities. So I have included Exhibit 3.4 from your text that gives you the step-by-step guidelines on how to prepare a three-part cash flow statement for your viewing pleasure.